1971, the day money stopped being real. August 15, 1971. A Sunday evening. Richard Nixon addresses the nation on television. He speaks for 18 minutes. Most Americans watching assume it's about Vietnam. It isn't. In those 18 minutes, Nixon announces the United States will no longer exchange dollars for gold. Effective immediately. No warning to foreign governments. No international negotiation. No transition period. The anchor that had held the global monetary system in place for 26 years was simply cut loose. And the world has been living with the consequences every single day since. Most people have never heard of what happened that night. The ones who have usually think of it as a technical adjustment. An economic footnote. Something that happened in a boardroom and stayed there. It didn't stay there. It reached into your savings account, your salary, your mortgage, your retirement. It changed what money is at a fundamental level. And understanding exactly what happened and why is the only way to read what is happening right now. Let's open the autopsy. To understand what Nixon destroyed, you have to understand what he destroyed it for. In 1944, with World War II still unfinished, representatives of 44 Allied nations gathered at a hotel in Bretton Woods, New Hampshire. Their task was to design a new international monetary system from scratch. The old one, the gold standard, had contributed to the Great Depression by preventing governments from expanding their money supplies during the crisis. They needed something more flexible, but with enough discipline to prevent the currency chaos that had defined the 1920s and 1930s. The system they designed was elegant. Every participating nation would peg its currency to the US dollar at a fixed exchange rate. The dollar itself would be pegged to gold at $35 per ounce. Any foreign government holding dollars could, at any time, walk into the US Treasury and exchange those dollars for gold at that fixed rate. The dollar was therefore not just a currency. It was a receipt. A claim on a specific quantity of physical gold held in American vaults. This arrangement gave America enormous privilege. Because every other currency was pegged to the dollar became the world's reserve currency. International trade was settled in dollars. Foreign governments held dollars as their primary reserve asset. American financial institutions sat at the center of global commerce. The United States could run deficits that no other country could sustain because the demand for dollars was essentially unlimited. But the privilege came with a discipline. The United States could only print as many dollars as its gold reserves could support. If too many dollars were printed and foreign governments lost confidence in the dollar-to-gold peg, they would demand gold. And the U.S. would have to hand it over. For the first decade after Bretton Woods, the discipline held. American gold reserves were enormous. The economy was growing. The dollar's credibility was unquestioned. Then came the pressures. The Vietnam War was expensive. Lyndon Johnson's Great Society programs were expensive. Rather than raise taxes to cover the costs, the government expanded the money supply. More dollars were printed. They circulated globally. Foreign governments accumulated them as reserves. And then foreign governments started doing the math. By the late 1960s, the United States held approximately $10 billion in gold reserves. The number of dollars circulating internationally had grown far beyond what those gold reserves could support. The dollar-to-gold peg at $35 per ounce was no longer credible. Any government that held dollars and wanted gold was essentially entitled to more gold than actually existed in American vaults. France understood this first. Charles de Gaulle, advised by economist Jacques Rueff, concluded that the Bretton Woods system was giving the United States an exorbitant privilege, the ability to run deficits and pay for them with dollars that the rest of the world was obligated to accept. France began systematically converting its dollar reserves to gold, sending ships to New York to collect the metal. Other European governments took note. The drain on U.S. gold reserves accelerated. Nixon inherited this problem from Johnson. By 1971, the U.S. gold reserve had fallen from over $20 billion to barely $10 billion. The dollar was running on reputation, not backing. Any major holder of dollars who demanded gold would break the system entirely. The choices available to Nixon were straightforward, but each was painful. He could raise taxes significantly to reduce the deficit and restore confidence in the dollar. He could cut government spending dramatically. He could devalue the dollar officially, raising the gold price and reducing the obligation per dollar. Or he could simply end the dollar-to-gold convertibility entirely and let the dollar float as a pure fiat currency. He chose the last option. On Sunday, August 15, 1971, without consulting America's Bretton Woods partners, without giving foreign governments the advance notice that the agreement technically required, Nixon went on television and announced that the United States would temporarily suspend the convertibility of the dollar to gold. The word temporarily did not survive contact with reality. The suspension has never been lifted. It has been 54 years. There is no mechanism in place to restore it. The dollar has been a pure fiat currency, backed by nothing except the credibility of the United States government and the global demand for dollars, ever since. Here is what that actually means. Before August 15, 1971, a dollar was a legal claim on a specific quantity of gold. It had intrinsic backing. The government could not print unlimited dollars because it would run out of gold to back them. The discipline was external, physical, and real. A government official who wanted to expand the money supply had to first acquire more gold or formally devalue the currency, a politically visible and costly act. After August 15, 1971, a dollar was a claim on nothing except the full faith and credit of the United States. The discipline was entirely internal, institutional, and political. A government official who wanted to expand the money supply had to convince the Federal Reserve and manage the political optics. No physical constraint existed. The immediate market reaction was, in the short term, positive. Stock markets rose. The dollar fell against gold but was still accepted everywhere. Nixon's approval ratings climbed. The television address had framed the move as strong action against currency speculators attacking America. Most Americans had no idea what had actually changed. What had actually changed was the nature of money itself. The data that follows is not opinion. It is the documented record of what happened to purchasing power after the gold anchor was removed. In 1971, a dollar purchased what a dollar purchased. By 2024, that same dollar purchases approximately 6 cents in 1971 terms. The dollar has lost roughly 94% of its purchasing power in 54 years. The pace of that loss was not uniform. It was not random. It tracked directly to periods of money supply expansion. The 1970s were the first and most visible consequence. With the gold constraint removed, the Nixon administration expanded the money supply to finance continued government spending. Inflation, which had been running at manageable levels under the Bretton Woods discipline, surged. By 1980, the United States was experiencing double-digit inflation. The price of gold, which had been fixed at $35 per ounce under Bretton Woods, rose to $850 by January 1980. That is a 2,300% increase in 9 years. Not because gold had become more valuable. Because the dollar had become dramatically less valuable. Paul Volcker, appointed Federal Reserve Chairman in 1979, broke the 1970s inflation by raising interest rates to nearly 20%. The cure was brutal. Unemployment surged. A severe recession followed. But the inflation was broken. And the lesson everyone drew from Volcker's success was that the Federal Reserve, as an independent institution committed to price stability, could provide the discipline that gold had once provided externally. That lesson was partially correct for a period of time. The 1980s and 1990s featured relatively low inflation. The dollar remained the world's reserve currency. The system seemed to work. The argument that gold was an outdated relic and that sophisticated modern central banking could manage monetary stability without any physical anchor gained significant credibility. Then came 2008. The global financial crisis confronted the Federal Reserve with a choice. Allow a financial system implosion that would cause enormous short-term pain but clear out the accumulated distortions. Or expand the money supply dramatically to prevent the immediate crisis at the cost of long-term distortions. The Fed chose expansion. The balance sheet grew from under $1 trillion to over $4 trillion in the years following 2008. Then came 2020. The pandemic confronted the Federal Reserve with the same choice at larger scale. The money supply expanded by more than 25% in a single year, the largest annual expansion in American history. The Federal Reserve's balance sheet peaked at nearly $9 trillion. The stimulus checks, the business support programs, the bond purchases, all of it was financed by money that was created because there was no external constraint preventing its creation. The inflation that followed in 2021 and 2022, reaching 9% at its peak, was not a surprise to anyone who understood what had happened in 1971. It was the predictable consequence of removing the discipline and then, 50 years later, testing how far an institution could go without it. Here is the forensic point that connects 1971 to everything this channel documents. Every hyperinflation, every currency collapse, every debasement examined on this channel, from Rome's silver dilution to Weimar's printing press to Venezuela's bolivar, shares one structural feature. The monetary authority removed or eroded the external constraint on money creation and then, under fiscal or political pressure, exceeded the limits that constraint had enforced. The Roman emperor who debased the denarius had no gold standard to prevent him. The Weimar Republic that printed marks by the trillion had suspended gold convertibility. Venezuela's central bank faced no external discipline on bolivar issuance. What Nixon did on August 15, 1971 was structurally identical to what those authorities did. He removed the external constraint. He replaced it with institutional discipline. An institutional discipline, as the documented record of every human institution under fiscal pressure shows, is less reliable than physical constraint. Not always. Not immediately. But consistently, over time, under pressure. The three things that happened after 1971 that would not have happened under a gold-constrained system. First, the total U.S. national debt grew from $400 billion in 1971 to over $35 trillion today. The removal of the gold constraint did not cause all of that debt, but it removed the mechanism that would have forced earlier reckoning. Governments that must finance spending through gold-constrained currencies cannot indefinitely spend more than they collect. Governments that can issue unlimited fiat currency can defer that reckoning for decades. Second, income inequality between asset holders and wage earners widened dramatically after 1971. When money is printed, the new money reaches financial assets first. Stock prices rise. Real estate prices rise. Bond prices rise. The person who holds assets denominates their wealth in inflating nominal values. The person who holds wages denominates their income in units that buy progressively less. The Cantillon effect, the observation that new money benefits those closest to its creation before filtering to those furthest from it, operated continuously for 54 years. Third, global central bank gold purchases began accelerating in ways that contradict the official narrative that gold is an outdated relic. In 2022, central banks globally purchased more than 1,000 tons of gold, the highest level since 1967. In 2023, another 1,000+ tons. In 2024, another 1,000+ tons. 3 consecutive years of record or near-record central bank gold purchases. The institutions that officially replaced gold with institutional credibility are quietly accumulating the asset they officially declared obsolete. The question the forensic record always asks is not whether the removal of the gold standard was the right decision in August 1971. Nixon faced a genuine crisis and the gold standard as structured had real limitations. The question the forensic record asks is what happens to a monetary system over time when the external physical constraint is removed and only institutional discipline remains. The answer is documented across the 54 years since that Sunday evening broadcast. The discipline holds until it doesn't. It holds longest when economic conditions are favorable, when fiscal pressure is manageable, when the political cost of restraint is acceptable. It erodes when conditions deteriorate, when fiscal pressure becomes acute, when the short-term cost of restraint exceeds the political will to bear it. Every saver who held dollars in 1971 and held dollars in 2024 holds approximately 6 cents of the $1971 purchasing power. The nominal number in their account did not change. The purchasing power did. The mechanism was not dramatic. It was slow, continuous, and almost invisible year to year. It was the same mechanism Marcus the silversmith felt in his palm in 260 AD when the denarius came back lighter than it should have been. The same mechanism that destroyed the savings of the German middle class between 1914 and 1923. The same mechanism every saver in every currency that has ever been detached from a hard anchor has eventually encountered. Nixon went on television on a Sunday night in August 1971. He spoke for 18 minutes. Most people watching thought it was about Vietnam. It was about the next 50 years. If this forensic breakdown gave you a new lens, subscribe to Independent Financial Historian. This channel runs the documented record, not the version of history that makes institutional decisions look wiser in retrospect than they were. Drop a hammer and anvil in the comments if you're already building the protocol. Tell me what you want me to dig into next. I read every single one. And remember what the 54 years since August 15, 1971 show clearly. The constraint was not the problem. The constraint was the protection. And the day it was removed, the clock started.